Hey everyone, I'm Professor Franklin. Today we're going to discuss an important topic that economists and investors closely watch during times of global conflict. How war can disrupt the U.S. economy and financial markets. Wars are not only fought on battlefields, they also create powerful economic consequences that affect businesses, consumers, and investors around the world. When conflict begins, supply chains can break down, energy prices can surge, and financial markets can become extremely volatile. Understanding these economic effects helps us better understand how markets respond to global crises. So today, class, let's explore how war disrupts the economy and how governments and businesses try to control the situation. One of the first economic effects of war is disruption to global trade. Modern economies depend heavily on international supply chains. Products sold in the United States often rely on materials and components that come from dozens of different countries. When war breaks out, these global trade networks can suddenly become unstable. Ports may close, transportation routes may become dangerous, and international sanctions may restrict trade. For example, when Russia invaded Ukraine in 2022, global commodity markets immediately reacted. Ukraine and Russia together account for a large share of global exports of wheat, energy, and fertilizers. The disruption of these exports quickly affected global prices and supply chains. Even when the United States is not directly involved in the conflict, the global nature of trade means American businesses can still feel the impact. Another major issue during wartime is the safety of global shipping routes. About 90% of global trade is transported by sea, meaning maritime routes are critical for the world economy. When conflict occurs near major shipping routes, transportation costs can rise dramatically. For example, the Strait of Hormuz, one of the most important oil shipping routes in the world, carries roughly 20% of global oil shipments. If conflict threatens this region, oil tankers may avoid the area or require expensive security measures. Shipping companies often add emergency surcharges during conflicts. In some cases, shipping carriers have added $800 per shipment in crisis-related fees, while marine insurance premiums for ships traveling through war zones have increased by over 50%. These additional costs ripple through the entire economy. Energy markets are often the most sensitive to war. Oil and natural gas, power transportation, manufacturing, agriculture, and electricity generation. When conflict disrupts energy supply, prices can rise quickly. For example, during the Russia-Ukraine war, global oil prices surged, and Brent crude climbed above $100 per barrel, the highest levels in years. Energy prices worldwide were projected to increase more than 50% in 2022 due to the supply shock created by the war. More recently, geopolitical tensions in the Middle East pushed U.S. gasoline prices up about 14% in a single week, with national averages reaching around $3.41 per gallon. When fuel prices rise this quickly, the effects spread across the entire economy. When energy prices increase, businesses face higher operating costs. Factories require electricity and fuel to operate machinery and production lines. Transportation companies depend on diesel fuel for trucks, ships, and airplanes. As energy costs increase, manufacturing expenses rise across many industries. Even materials such as plastics, chemicals, and metals require large amounts of energy to produce. This means that energy price shocks during war can increase the cost of producing everything from electronics to automobiles. These higher costs reduce profit margins for companies and can push stock prices lower. War can also create shortages of important materials used in manufacturing. For example, Russia and Ukraine are major exporters of metals, energy products, and agricultural commodities. When these exports are disrupted by war or sanctions, supply becomes limited. At the beginning of the Ukraine conflict, global petroleum inventories were already about 11% below their 5-year average, making the market even more sensitive to supply disruptions. When supplies are already tight, even small disruptions can cause significant price spikes. These shortages can slow production in industries ranging from automotive manufacturing to technology. Now, class, let's imagine a situation where tensions between the United States, Israel, and Iran escalate into open conflict. One of the most critical locations in this scenario is the Strait of Hormuz. This narrow waterway connects the Persian Gulf to the Arabian Sea and serves as one of the most important energy routes in the world. Every day, roughly 20 million barrels of oil pass through the Strait of Hormuz, representing about 1/5 of global oil consumption. Major oil-producing countries such as Saudi Arabia, Iraq, Kuwait, and the United Arab Emirates rely on this route to ship their oil to international markets. Iran sits directly along this strategic choke point. If a military conflict were to threaten shipping in this area, tankers might avoid the region entirely or require military escorts. Even rumors of disruptions in the Strait of Hormuz can cause global markets to react immediately. Oil traders, shipping companies, and financial markets monitor this region closely because any disruption could have immediate global consequences. For the United States, which is deeply connected to global energy markets, instability in this region can quickly influence prices and investor sentiment. Now, class, let's examine what happens when energy supplies are disrupted. If a conflict between Iran and the United States or Israel interferes with oil shipments through the Persian Gulf, the global oil market could experience a major supply shock. Some analysts estimate that disruptions in the Strait of Hormuz could affect up to 10 million barrels of oil per day, depending on the severity of the conflict. When supply decreases, while global demand remains strong, prices can rise quickly. During previous geopolitical tensions, oil prices have surged above $100 per barrel within days. In more severe conflict scenarios, some economists warn that oil prices could climb toward $150 per barrel or higher. These price increases do not remain limited to oil markets. Higher oil prices increase transportation costs for airlines, shipping companies, and trucking businesses. Manufacturers also face higher energy costs for factories and production facilities. This creates a chain reaction throughout the global economy. Now, class, let's talk about inflation. Energy is one of the most important components of the modern economy. When oil prices rise, it becomes more expensive to transport goods, power factories, and produce many everyday products. Economists estimate that every $10 increase in oil prices can increase inflation by approximately 0.2 percentage points. This may sound small, but across a large economy like the United States, the impact can be significant. Higher fuel costs affect trucking companies delivering food across the country. Airlines raise ticket prices to offset higher jet fuel costs. Farmers pay more for diesel fuel used in agricultural equipment. All of these costs eventually reach consumers. Households may suddenly face higher prices for gasoline, groceries, airline tickets, and electricity. As a result, inflation can rise quickly during periods of geopolitical instability. Financial markets respond quickly to geopolitical events. When a major conflict breaks out, investors often react to uncertainty by selling risky assets. Stock markets can experience sharp declines as investors attempt to reduce exposure to risk. For example, during major geopolitical crises, The S&P 500 index has historically experienced short-term declines as investors react to uncertainty. At the same time, investors often move capital towards safer assets. Gold prices frequently rise during geopolitical tensions because investors view gold as a store of value. U.S. Treasury bonds may also attract demand because they are considered relatively safe investments. This movement of capital between different asset classes can cause significant market volatility. Trading volumes increase as investors attempt to reposition their portfolios. While markets often stabilize over time, the initial reaction to geopolitical shocks can be dramatic. Now, class, how do governments respond when these economic shocks occur? One of the most important tools available to the United States is the Strategic Petroleum Reserve, often called the SPR. This reserve stores hundreds of millions of barrels of crude oil in underground storage facilities. During major energy disruptions, the U.S. government can release oil from the Strategic Petroleum Reserve to increase supply and reduce price spikes. Another important response involves cooperation with allies. The United States may coordinate with other energy-producing countries to increase global oil production. International naval forces may also work together to protect shipping lanes and escort oil tankers through dangerous regions. These actions help maintain the flow of energy through critical trade routes and reduce the risk of severe supply disruptions. So, class, what is the main lesson from this scenario? A military conflict involving the United States, Israel, and Iran could have significant consequences for global energy markets. Because so much of the world's oil moves through the Persian Gulf, disruptions in this region can quickly affect energy prices, inflation, and financial markets. Higher oil prices can increase inflation, reduce consumer spending, and create volatility in stock markets. But history also shows that economies are remarkably adaptable. Governments introduce policies to stabilize markets. Central banks adjust monetary policy to manage inflation. And businesses reorganize supply chains to reduce exposure to geopolitical risks. Over time, markets often recover as uncertainty fades and new economic balances emerge. Understanding these patterns allows investors and policymakers to better navigate periods of global instability. I'll see you in the next lesson.